So basic session for today, we shall be discussing about a few of, or I would say like one of the most important valuation ratio, which is being used to value a loss-making company. Okay. So in the previous session, if you guys have gone through the recordings and the different modules like which are there on the website already, you might be aware about the different deep dives that we are doing from the previous sessions, short deep dives, right? We talked about the price to earning ratio for one particular session. We talked about the price to book value ratio. We talked about the EV to EBITDA ratio. We talked about CFO to PAT. We talked about cash to market cap, right? So in the session for today, we shall be completely oriented towards talking about one of the loss making companies ratio. And if we have time, then we shall be discussing about either one or two of the free cash flow ratios also. Okay. So first of all, we shall be discussing about, which you might have heard about already, the price to sales ratio. Price to sales ratio. What exactly is the price to sales ratio and why is this ratio important and why it is used? So see, if we talk about the other metrics, be it the price to earning ratio or the EV to EBITDA, so all these metrics or all these valuation ratios have one thing in common. The one thing is the company needs to be profitable, either at the PAT level or at least at the EBITDA level. So if the company is profitable at the PAT level, then price to earning can be used very easily. If the company is profitable at least at the EBITDA level, right, then EV to the EBITDA ratio can be used easily, right? Apart from that, there are multiple other reasons also why we tend to use the EV to EBITDA ratio, and that we have discussed already, deep dive in the previous session. We also talked about adjusted EBITDA and cash EBITDA, right? So two types of EBITDA also we talked about in the previous sessions. Why is price to sales used? See, one thing is price to sales ratio is used when a company is loss making. The only time or the only, I would say, reason why company would be using a price to sales or a valuation analyst or a financial modeling expert shall be using the price to sales ratio is when he shall be valuing a loss making company. जब भी वो एक लॉस मेकिंग कंपनी वैल्यू करेगा, only that scenario he shall be using the price to sales ratio. There is no other reason that he shall be using price to sales ratio in that scenario. Now again, many of the analysts or many of the research guys or the valuation experts have also commented that price to sales ratio is not a good ratio to work upon because it doesn't tell about the future profitability of a company. Because किसी भी company की, in this case, if anyone is using price to sales, the current profitability is not there, right? And also there is no expectation that the company shall become profitable in the near future too. Then why even to use the price to sales ratio? Then why even the price to sales ratio exists? Now it is your task to differentiate between a fundamentally strong company and a fundamentally weak company. If such kind of a price to sales metric is being used for a fundamentally weak company, which cannot even become EBITDA positive or somewhat break even or become a profitable at the EBIT level or the operating profit level or somewhat later at the PAT level, it's ways to use such kind of ratios for those type of companies. But if you believe the business model for the companies is solid, the companies can do really good, right? And it is justified that the company can become profitable in future, be it at the PAT level or the EBIT level, that is your earnings before interest and tax, like which is also called the operating profit of the firm, or at least at the EBITDA level, then price to sales can be used. Because it is a metric which is being used to gauge the valuation of the enterprise based upon the sales. It's also called as a sales multiple. If someone asks you that what exactly is the sales multiple, price to sales is a sales multiple. In earnings multiples, in pricing multiples, we tend to say price to earning multiple, price to book value, price to cash flow, right? But in the sales multiple, there's something called as the price to sales, where you are valuing a company based upon sales. And you are always having an underlying assumption that the company will become profitable because the first step for a company or any of the company in the market to become profitable is to focus on sales because sales will translate to profits and higher profits will make a company much more profitable at the PAT level. So higher profits here I mean at the at least the beta level then EBIT level, and then the PAT level. Because anyways, the initially, whenever a startup comes into place, or a company starts its own business, or like anyone starts its own business, the first parameter is to focus towards the sales volume. They have to focus upon volume and lesser towards the profitability. But a time comes after 7 years, 10 years down the line, the focus has to shift towards profitability and less towards volume. But initially, as the company has to capture the market share, the company wants to grow in market, it has to focus upon sales volume because sales translate to the total revenue of a company. It's also called as a top line. The bottom line of the business is always the profit, the PAT, the profit after tax. But the top line is always your sales, the total revenue of a business. So if you want to value a company based upon sales, then price to sales multiple is used. Now here, the price, the numerator, again, it is the current market price as we have discussed previously also. The current market price trading in the market is the numerator that we tend to use. So for example, if I want to calculate the price to sales ratio for a company as of today, so I'll be taking the latest current price of a company that is as of yesterday, the Friday closing. So I'll be taking the current market price in the numerator and dividing it by the total sales of that company. Now, this sales include both the cash sales as well as the credit sales, right? It includes both your cash sales as well as the credit sales because the company is focusing upon volume. And this price that you see here is a CMP, the current market price of a share. And from our previous discussions, our previous analysis and understanding, we always know that price is a leading indicator. Price tend to change on account of market sentiments. If the market sentiment is positive, the price will rise. If the market sentiment for that particular stock or company is negative, the price will fall. And the second parameter, you have something called as sales, which encapsulates or which tries to encompass both the cash sales as well as the credit sales, right? And again, this sales is again a lagging indicator. It's not a leading indicator because you do not get the sales number published on a daily basis. Price tends to fluctuate on daily basis. Every day, the price tends to fluctuate by some basis points, right? It might be even 0.00001%, but the price tends to fluctuate. But sales is something that will fluctuate, but you won't get the daily sales number because companies they tend to report their numbers either on a quarterly basis or yearly basis, right? So sales they have taken in the denominator, and these are the quarterly reported sales or annual reported sales. So that is why the denominator of this ratio, that is sales, is a lagging indicator, whereas price in the numerator is a leading indicator, which is affected by market sentiments, good positive news, right? A company might do capex, a company might do some good capex towards investments, towards diversifications. The company might still be at losses because initially, why the company is into losses or why the company has negative cash flows. Because initially the company is spending the greater chunk of money for its investments, for its expansions, diversifications. So even if the company is a loss-making company, but fundamentally strong in terms of sales, has good projections for future, have good projections to break even. And how do we make these kind of projections to break even? That we'll discuss also, right? Because as of now, how can I tell if a company is or a company can break even after 5 years or like 10 years or 12 years down the line? There's a way to do that. I'll tell you that also in the subsequent sessions. But that is the thing. So price we're taking here because price will tend to fluctuate if some kind of positive sentiment is there about that particular company or stock. And even if the bottom line or the profitability of that company is negative, it's into losses, the cash flows are negative, still the stock price might rise because there might be a possibility that the company will break even. The expenditure or the investment for diversification for expansion is justified, right? So ये इसका basic logic रहता है. How do we tend to value it? Simply, we're trying to compare a company. It's basically trying to price a company and not value because all these multiples of relative valuation that we talk about, it's more of the relative pricing and not relative valuation, right? So basically, we are doing relative pricing here and not relative valuation, be it price to earning, price to book value, EV to EBITDA, anything. Okay, so relative pricing is being done here. So वही चीज करते हैं. If we want to know the price for our company and our company wants to get listed on the stock exchanges, हमारी कंपनी को stock exchange पे list होना है And we want to know that how much price should be assigned as per market sentiments, as per market pricing. So I'll be taking the price to sales of a similar company in the industry. So for example, if my company is into the consumer tech, or basically if my company is into online retail, so I'll be seeing the price to sales multiple of either an average price to sales multiple of the retail sector, or I can pick up simple price to sales ratio of one particular company in that industry. The best way is to take an average price to sales ratio, which tends to encapsulate every company in that particular retail industry. As told previously also, always price your company relative to a similar company in the same industry only. So assumingly, hypothetically, if the price to sales, the average price to sales over past 10 years or past 5 years, as per your calculation, for the retail sector has been 10. Price of your company you want to calculate, and your company is making a sales of 2 crores per se. Okay? For example, it is making, right? Or your company is making a sale of how much? The company might be making a sale of 2 lakhs or 20, right? It might depend. So what's the price? Price will become this 20 into 10. So in this way, by having a relative comparison towards existing price to sales ratio on an average basis, which is trying to encapsulate the price to sales of every company in the retail sector, but trying to gauge the price for your company. The same logic we use for price to earning, price to book value, and EV to EBITDA. But what is the major drawback for this price to sales? One drawback, as we discussed already, the company might not be a fundamentally strong company. It might not even become EBITDA positive. And the second drawback is, see this component of sales. This component of sales is using both the cash sales as well as the credit sales. Cash sales are good, but the credit sale is something which is problematic. Even a bigger profitable company has the probability that it won't receive the money from debtor. Such kind of startup companies who don't have market stability or have least amount of market share, there is an even higher probability that the debtors won't pay them back. They might think एक नई कंपनी है, इससे इससे सारा सामान ले लो, पैसे दो ना दो क्या फर्क पड़ता है. So this is the biggest risk. And that is why we have to bifurcate between the cash component as well as the credit component, and that we can see in the notes to account. If 100 is your sales and more than 70% is credit, just make a note of this point, how you can identify a red flag in a company. If you go to notes to account of a company which is a loss-making company, you're valuing that company based upon price to sales के basis पे. Sales देखते हो company की, cash sales भी हैं, credit sales भी हैं, go to notes to account. If the credit sale is more than 60 to 70%, it's a red flag. The money might not come back to company. Majorly, at least 60% of the money should be cash sale. The company should get that money on prompt. कितना रिस्क दोगे, कितना लेवरेज दोगे इस कंपनी को, कितनी लेवरेज दोगे? लॉस मेकिंग ऑलरेडी है, कैश फ्लो नेगेटिव है, एबिटा पॉजिटिव भी नहीं है. एटलीस्ट सेल्स, द मेजर क्वांटम शुड बी कैश सेल्स. What I personally do, I remove the component of the credit sales and I just take price to cash sales number. It's also called as modified price to sales ratio in my terminology. Like many people don't use it, many people have not even thought about it. But to have a clear fundamental analysis of a company fund to exactly gauge the fundamental strength of a company, remove the credit component and take price to cash sales ratio, modified price to sales ratio. You will actually have a good fundamental closer valuation of a company. Though again, that's pricing, but that can be set as a 50% pricing and 50% valuation, right? So that is the thing. Take the cash component for better understanding. If not, you have calculated the price to sales already. Just see the notes to account. If more than 60% is the credit, ignore that company. You need not value that company anymore. Now, I'm not saying a company having more than 60% kind of credit sales cannot flourish. It might also become profitable, right? But the chance is less because when you enter into an equity market, you always take that risk. Correct? The bet might be wrong. The bet might be correct, right? But as a conservative investor, or when you're trying to identify a red flag for a company, one such is an issue that you need to see via the notes to accounts. That the maximum quantum should be cash sales and not the credit sales. इसी का ही मॉडिफाइड वर्जन इज ईवी बाय रेवेन्यू, ईवी बाय रेवेन्यू रेशियो. If we talk about the denominator first, sales is a part of total revenue of a business. Number of products into price, it gives you the total revenue for that company. How many products you are selling into the price of each product. It gives you the total revenue for that enterprise. And in the numerator, you have the enterprise value. EV by revenue. Again, same logic as price to sales. It is just a bigger version of the price to sales ratio. Because your revenue, it doesn't even just encapsulate sales, it also has other income. You might have sold off some investments, some gain on sale of machinery, some dividend received, some kind of gain on sale of investments. All these components, they become part of the other income, and that becomes part of total revenue. And we all know that what is enterprise value. If you do not know what is enterprise value, how to calculate it, please watch my previous session upon EV to EBITDA. My previous session on the difference between the market cap and EV. EV is not just the total value of a company in terms of equity and debt. It is equity plus debt plus minority interest. You add all this, you subtract cash, because cash being the non-operating asset. And if a company has cross holdings, again, you tend to subtract the market value of cross holdings and not the book value of cross holdings. We have talked about what are cross holdings as well. Watch my previous sessions, right? So to have an understanding, a deep dive understanding of these sessions, you always have to watch my previous sessions. Now, here I do not mean that if you don't watch my previous sessions, you won't understand things. You will understand things, but you won't understand things in deep dive because you won't be able to relate the formulas or logic. Correct? So that is your enterprise value. So if we try to have, if someone asks you to explain this ratio, price to sales. So basically you can say on a $1 sales value, for a $1 of sales or a 1 rupee of sales the company makes, how much price is assigned to that company. So if the price to sales ratio of a company is 2, it means for 1 rupee of sales or $1 worth of sales, an investor is willing to pay 2 rupees or $2 for 1 worth dollar or rupee of sales the company makes. And same logic for EV to revenue. For a $1 revenue the company makes, the investors, both from an equity point of view and debt point of view, assign a value of 2 to the company. एक ही रेवेन्यू के बेसिस पे वो कंपनी की वैल्यूएशन को 2 गुना पैसा देने को तैयार है कंपनी की वैल्यूएशन के लिए, बोथ द इक्विटी होल्डर्स एंड डेट होल्डर्स. यहाँ पे यू आर टॉकिंग जस्ट अबाउट इक्विटी होल्डर्स, प्राइस इज मार्केट कैप. Here we're talking about enterprise value. Sometimes this ratio is also used as market cap by revenue. Market cap by revenue. So simply they have just done sales का बड़ा version ले लिया, right? In terms of revenue. And this they have taken price into number of shares, because price into number of shares, it gives you the market cap. The price of a particular share into number of shares, it gives you market cap, dividing by revenue. So market cap by revenue, EV to revenue, price to sales being used for loss-making companies. Very useful. You should know about these indicators. Correct? So that's about price to sales, EV to revenue, and market cap by revenue. Any questions? Any questions to this point of time? So, okay. So this session we talked about price to sales, we talked about EV to revenue. These are very short sessions I'm keeping for everybody. In the next class, we'll talk about price to free cash flow ratio, deep dive. We'll talk about how to calculate free cash flow to firm, how to calculate the free cash flow to equity. All these things we'll talk about, and price to free cash flow ratio. Right? So this ratio we'll talk about in the next session. And what's my main reason to keep these sessions too short? To make you understand these things to the crux. Right? That is the major thing. We talked about price to sales, adjusted price to sales. That is what just taking the cash component in your denominator, EV to revenue, and market cap by revenue. So watch these sessions multiple times. Also watch my previous session, because the quality of content I'm trying to bring for you, like you'll be finding it nowhere. Right? So value such sessions, watch such sessions. If these sessions are like available to you, watch these sessions, try to get the maximum crux out of it. Because many of the corporate interviews are centered around what I am teaching via these live sessions. How to explain conceptually, fundamentally, calculation wise. तो वो चीजें समझो, right? And try to value all these things like which are being part of these live sessions, because we're trying to bring you the best outfit content, right? Okay, so see you in the next session. Thank you so much.